What's going on, guys? In this video, I'm going to share with you how to become an accredited investor. In this video, I'm going to walk you through what it means to be an accredited investor, why it matters, and at the end of the video, I'm going to share with you how to invest in startup companies even if you're not an accredited investor. So make sure you watch this video until the very end and be sure to make that investment in the like button. I really appreciate it. If you guys are new here, I talk about investing in startups, entrepreneurship, and a behind the scenes look at what it's like to build a global technology and media company. So make sure you subscribe to the channel and let's get right into it. So right away, there's 3 requirements that you have to fulfill to be what's called an accredited investor. And all this means is a designation by the SEC, Security and Exchange Commission, that you are a professional investor, and it allows you to invest in things that the general public cannot do. So there's 3 criteria. There's either a wealth requirement, so basically your net worth has to be above a certain level, or you fulfill an income requirement, so you make above a certain amount, or you have something that's new, a knowledge requirement. So you're actually just certified to be an accredited or professional investor simply because you have this knowledge and you're like licensed. We'll talk about each of these. But before we get into that, like, why does this matter? Like, why is this a big deal if you happen to be accredited, and what privileges do you get if you're what's considered a professional investor? And really, it basically gives you legal access to products that are not available to the public. And these products are things like hedge funds, venture capital funds, private equity deals, angel investments, investing in private companies, basically entities or assets that are not regulated like a publicly traded company. So if you go and invest in like Tesla or Apple or Facebook or one of these giant tech companies, they have specific rules that they have to follow because they're a publicly traded company. And if you're a private company and you're a smaller company, maybe you're doing only, a few hundred grand in revenue or a few million in revenue, private entity, 50 employees, 20 employees. So you don't have to file certain things with the SEC like you do with a private or a public company. And so because of that, there's an additional amount of risk. And so the SEC is basically just trying to protect people. You can agree or disagree with if that's the right move to do, but that's how it is and that's how the rules work. So there's another thing that gives you access if you're a professional investor. You can invest not only in these venture capital deals or in hedge funds, but you can also invest in equity crowdfunding deals. These are basically deals that are open to the public, and you can invest on platforms like Seed Invest or AngelList. But I have this circled here, and we're gonna get back to that because at the end of the video, I'm gonna share with you how you can invest in equity crowdfunding companies, basically private companies that are listed online, even if you're not an accredited investor. So now that you see what some of the advantages are of being an accredited investor, let's talk about what those requirements are. So the first one is the wealth requirement. This basically means your net worth. And you can qualify either individually or jointly. So if you have a significant other, if you're married, your husband, your wife, whatever, you have a net worth over $1 million. And this has to be a liquid net worth, not including your primary residence. So a lot of people think they qualify because they live in a, $500,000 or $1 million house and they have a few $100,000 in stocks or in equities in some other fashion. But no, your primary residence does not count. So the place that you live doesn't work. And when you calculate your net worth, you're actually calculating it by your assets minus your liabilities. So if you've got, a $1 million house and that's your primary residence, doesn't count. You have a second house that's worth $500,000 and you have $300,000 in equity, and then you have $800,000 in your 401k and your stock market brokerage account. That would be $1.1 million. So then you would qualify as an accredited investor. And also there's actually another piece to this that you might be able to qualify from the wealth perspective, and that is if you are a director, a partner, or an officer of a company that is issuing the securities. Basically, this means if you happen to be one of the officers or directors of the company that is raising funds, then you by default are an accredited investor because of your position in that company. So basically, you can invest in your own company as an accredited investor. So that doesn't really apply for most people, but that's how we talk about the wealth requirement. So a lot of people don't fit that requirement. They don't have $1 million in net worth. Maybe they would if you can count your primary residence, but most people don't really fit into that category. So what about income? If you don't meet the criteria on net worth, you might meet that criteria from an income perspective. So this basically states you have to make over $200,000 per year USD, or over $300,000 you and your significant other, so your partner. So it's 300,000. So let's say you make 150, partner makes 150. Boom, we're at 300, and you got it. So you don't have to actually meet that 200,000 if you can combine your income with your spouse, and then you get pushed over. And here's the other kicker to that: it has to be for the last 2 years. So it's not like you just all of a sudden made a ton of money. For the last 2 years, and you're expecting to make the same amount for this coming year. So basically, if you made 200K or something, got a good gig, and then you retire or you stop working and you don't plan on making that money in the future, you technically don't actually qualify under this new rule. So if you don't meet the wealth requirement, maybe you meet the income requirement. Some people meet the income requirement, but they don't meet it on the net worth requirement. You just have to qualify under one of these categories. And then the third and the newest, thanks to something new that the SEC published as of August 26, 2020, basically allowing more people to qualify because the SEC luckily realized that this is a little too restrictive. Because think about it, you can go gambling in the casino, but you can't go and invest in your favorite startup. It doesn't really make a lot of sense. So they added this new requirement, which kind of solves that, which is the knowledge requirement. So if you don't meet income, you don't meet net worth, you might be able to qualify through this. It's still a little restrictive, but I'll briefly overview. And by the way, I'm going to link a few different resources from the SEC that go over all of this in way more detail so you can dig into it. But I kind of summarized it here. Basically, you could meet the knowledge requirement by some kind of a professional certification. And basically, this could be a number of different ways. Maybe you're a general securities representative, or you're a licensed investment advisor. So you basically work in the industry. You don't have to have the income, you don't have to have the net worth, but you have some kind of a certificate or something like that. Or private securities offering representative. So if you have some of these certificates, you might qualify. Or you're a knowledgeable employee. I know it sounds kind of ironic, but basically the directors and certain officers of a private fund. So let's say you work for a fund, the fund isn't paying you over 200 grand and you don't have the net worth, you can still invest on behalf or individually through this right there. Or maybe it's a family office. So a family office normally someone has made some money at some point, and maybe you work for the family office, maybe you're a family member, and so you could be a family client of a family office. So maybe some of these family offices are a group of wealthy individuals. So maybe you can qualify through that way. And then the final one here, there's actually a few, I didn't list all of them, but LLCs that have more than 5 million in assets. So you might be able to invest on behalf of an LLC that you maybe own or something, and it has over 5 million in assets. So you, again, don't have over 200K in income. Maybe you personally, your net worth is not that high, but you're in that position as an officer or whatever, and you can make investments on behalf of the LLC. Also, if you're a state registered investment advisor, and like I mentioned, I'm gonna link from the SEC, all of that stuff. So if you wanna get into it, go ahead and dive into it. There's a lot of things in there. We won't get too much into the weeds. But now the moment you've been waiting for: how do you invest in startups if you're not an accredited investor and you don't meet this criteria of wealth, income, or knowledge, which is the majority of people, and probably if you're watching this video, you probably fit into that category. No problem. A lot of people are in that boat. And so how do you invest in startups? Basically, thank you to the Jobs Act that was rolled out way back with Obama. And then in 2016, private companies were able to publicly solicit for funds. So private companies were able to raise money up to $1 million. So any of the big crowdfunding platforms, I mentioned equity crowdfunding, that don't allow you to be an accredited investor, you can invest up to you can raise money up to $1 million. So you can invest up to 10% of your income in private companies through that method. And basically, some of the big platforms that are out there are WeFunder, Republic, and Start Engine. I'll make sure they are linked down below. Tons of startups are raising on each of these awesome companies. And as of March 15, 2021, the SEC upped the rules, and now these companies can raise up to $5 million in their round. So this opens it up to a lot more people and a lot more companies that are interested in investing in startups. So same platforms, WeFunder, Republic, and Start Engine. There's actually over 60 of them. I just mentioned the biggest ones that are out there, and there's hundreds of startups that are raising at any given time, and you can invest for as little as $100 in a lot of these platforms. You can invest 500, 1,000, 5,000, whatever, all the way up to 10% of your income if you're not an accredited investor. And by the way, it's 10% of your income, not just in one company, but in all of the investments you do in 1 year in these private startups. So if you invest, you make 100 grand a year, you can only invest $10,000 per year. So I wouldn't say, you put $10,000 in one startup. Maybe you invest in like $2,000 each. There's also, on the equity crowdfunding side, there's AngelList and Seed Invest, and these have a combination of some you have to be an accredited investor, and others the deal will tell you basically if you're just a regular person. Anyone can invest for as little as $100 or $500, whatever the minimum is of that startup on the platform. But I hope you guys enjoyed this video. Again, this is for entertainment purposes. I'm not your financial advisor. Always do your own due diligence before making any investment decision. Make sure you invest in that like button. I can tell you to do that. And let me know what questions you have down below in the comments, or what startups you're investing in, and any other questions you have about this space. I love helping you guys out. Let me know how I can do that. And I wish you guys the very best, and keep hustling.